Good morning, everyone. My name is Greg Carlson. I'm president of NYARM, and I welcome you here on this nice festive Tavern on the Green. On behalf of NYARM, I hope everybody had a nice Thanksgiving, and for the holiday season, I wish you, your family, your loved ones, and friends a happy and healthy holiday. So let's start the ball rolling. I'm going to introduce to you our moderator and NYARM president, Michael Wolf.
I'm president.
Okay, treasurer. I'm sorry, treasurer.
Greg's the president. Good morning, everyone. Thanks for coming. We're starting a little bit late, so I'm going to move a little quick, but I'm not going to take any time away from our panelists. And we have a great panel today. We have Robert Molina. You raise your hand? Okay. Pat Nyland. David Lipson. Okay. Erwin Cohen. Okay. No, I'm moving right along. Bob Candell. Paul Korngold. Danny Wallman. And Stuart Warshaw. Thank you. As you know, our topic is budgets, and what we've assembled, actually Margie's assembled for you, are our managing agents, CPAs, certiorari attorneys, a mortgage broker, a fuel energy supplier or alternative fuels for you to help you with your budgets. So we're December 2nd, so most of your budgets should have been provided. They're in process, just about be ready to present it to your boards for presentation or approval. Could be a daunting task for those of you who really aren't familiar with the process, and our goal today is to try to help you through that. What we're going to do is hold the questions and answers until the end of the presentation, and we'll spend as much time as we can with you to do so. Now's a good time to put your phones on vibrate if you haven't done so already. Okay. What's that? Vibrating? All right. So we're going to start with Robert Molina. Robert Molina is a CPA, and he's going to discuss the CPA's budget process through a CPA's eyes.
Thanks. Good morning, everybody. For those of you that don't know me, I'm Robert Molina. I'm a partner at the firm Zeidman, Lakowitz, Preisand & Company. We've been in this industry for over 30 years. We have over 200 co-op and condos that we handle, get involved in many cases with the budgets. A lot of times the management companies do it themselves and don't involve us, which is good in a way. But just want to highlight a few things today without boring everybody with too much accounting rules and budgets. One of the single biggest mistakes we find that buildings do is to not do enough planning. A lot of them don't want to either spend the money or they want to keep their heads in the sand and not look forward to do a 3 or a 5 year capital plan. When they do the operating budgets, they don't want to factor in that you may need to do capital projects or other major repairs down the road as well. We've seen buildings, for example, we had a building on the Upper West Side that went out and refinanced their mortgage. They lowered the debt service. It was great. They didn't need a maintenance increase that year. And then 2 years later, they had to do exterior work and had to go back out and refinance again and incur a second set of closing costs and legal fees, which was an absolute disaster. One of the big things we're seeing this year, which I'm sure a lot of you are seeing now, is a lot more flack from the banks. Most banks, like NCB and all the other banks that give the mortgages to the co-ops, require the buildings to have a balanced budget. The offering plans for the buildings generally also require a balanced budget. It's something that we haven't seen banks really look at too closely until the last couple of years when the banking industry went crazy. But now we're getting a lot of letters from the banks saying, why is how can you don't have a balanced budget? Or even if you have a balanced budget on paper, they're looking more closely at the line items and saying, well, real estate tax was $300,000 last year. It's not going to be $250 next year. There's no way that's happening. And they're stepping in. Of course, it puts you guys in a more difficult situation. It's hard enough getting the boards to put through maintenance increases as is and catch up. We're also seeing some banks that are looking now to try to force the buildings to put in a monthly reserve fund contribution. As a general idea, we do believe it's a good concept that buildings put aside a little bit of money every month into the reserve fund for future capital projects. Now we're seeing some of the banks trying to enforce that more, also enforce having a minimum amount of, a minimum balance within the reserve fund, which all comes into play. As I said, we do recommend that you do that try to get the buildings to do a 5-year capital study to see what kind of improvements they're going to need. Then you're able to put together a little bit better plan as far as financing it, taking out a mortgage or a line of credit if necessary. So that's another thing. Now, just to go through a few things briefly as far as the budgeting itself. When you looking at the budgets each year, it's a good idea to look at each building and try to brainstorm a little bit and figure out new ways of raising revenue. We've had some buildings do some different things over the years. Flip a lot of building. Not every building has a transfer fee or a flip tax. If you don't have one, it's difficult to get through, but it's a very good idea to help raise money for either for operating or more likely for capital purposes. There's a lot of buildings that have transfer fees in place where the policy was set 30 years ago, and you have a transfer fee of $2,000 or $3,000 on an apartment that's selling for $2 million. That kind of $3,000 made sense 30 years ago, but it doesn't today. So the policy should be looked at again to modernize. We've seen buildings.
I'm sorry, I just have to
Yes,
interrupt
sure.
a minute. Is someone in this that should be in the other seminar because we've got two seminars going on? Frank Basso? Frank? Okay. If the fire, you're here for the fire safety, right? Okay. So I just need.
Okay.
Thank you. Sorry.
No problem. Okay, also with the revenue, if the building doesn't have a transfer fee, you should probably put in a large move-in, move-out fee. We've had buildings sell air rights. We've seen buildings issue shares of stock to hallway space to bring in extra revenue, adding storage units. We've had a building out on the island that took away a community room and added an apartment, issued shares to that unit to bring in some upfront money as well as monthly maintenance on that. We had a building in Queens that sold off a vacant piece of land, antenna leases. We had a building that took in $5 million for air rights sale last year, which was terrific. And generally, we recommend that you don't budget the transfer fees or interest income into the operating budget, because those are generally stay in the reserve fund. And unless the building really is going to transfer the interest income back to operations, you really shouldn't put it in there. On the expense side, too, as well, look for whatever ways you can save. An interesting thing, we've had a number of buildings where we've done some, going back for 5 to 10 years and done spreadsheets to see where the expenses have increased over the long range. And the one area that's increased the least over the 7 to 8 years, of course, is the professional fees. The management fees and accountant fees, we somehow always end up at the short end of the stick. Utilities. There'll be somebody speaking later on about energy. Let them get into that. We have some sub-metering, if the building hasn't already sub-metered. I had a building in Coney Island that was going to get a full sub-metering for the whole building funded by NYSERDA, and the shareholders shot it down. So now they're going to have to do it again at some point and pay for it. They blew that one. As you know, the water and sewer rates have gone through the roof. The fuel costs have gone through the roof. Another big ticket item, of course, is the wages. As you know, the union contract is up this year. I think someone's going to be speaking a little more later about the union contract and the expectations of that as well. With the real estate tax, we got the new rates out. And again, somebody else will speak a little bit more about the real estate taxes. The insurance the last couple of years has finally been coming down a little more. That you're subject to less and less vendors that are willing to give insurance to buildings. So the rates have gone up after September 11th, but finally we're seeing it come down a little bit more. Repairs and maintenance, so that, of course, is the toughest area for us as accountants to look at because we really don't know anything about the building systems and the maintenance end of it. But one of the keys, not just here but overall, is to encourage the boards to be realistic. It's easy to sit at a budget meeting and say, knock 10,000 off of this line and 10 off of that, which looks great on paper, but the reality is you're not going to be able to pay the bills. The mortgage rates now are pretty favorable. There'll be someone else speaking about some of the nuances of refinancing. We have seen condos get loans as well. If the condo owns the super's apartment, they can get a mortgage on the super's apartment. If they don't, they can still get an unsecured loan. It's a little more difficult than a co-op, but it is available. We also encourage our buildings to put a contingency line into the budget. In government housing, they require you to put in a 2 or 3% contingency line. Most free market buildings don't do that, but it is a good idea, particularly with the volatility of fuel costs and other items. And as I mentioned before, reserve funding, we also encourage buildings to try to incorporate some sort of a monthly reserve funding into the operating budget to put away some money for future projects. And we'll take some questions and answers later. Just one other topic, which really doesn't affect budgets, but is something that has come up a lot very recently, is sales tax. New York State is desperate for money. I'm sure you've had a number of buildings that have gotten hit with sales tax audits in the last year or so. They're coming out aggressively after the buildings. You do $1 million waterproofing job that you say is a capital improvement. They come in and say it's a repair and it's subject to tax. And it comes down to what kind of an agent you get and how willing they are to negotiate. But in terms of trying to protect yourself, a lot of times we'll see a contract signed, and right in the contract it says repair facade. You know, never use the word repair if you're going to use it as, if you're going to claim it's capital and not pay sales tax on it. Try to use restoration of facade or some other fancy word, but try to avoid the words repairs and in there as well. There's, on the New York State website, there's a publication 862 that has a good breakdown of all different, any kind of repair you can think of and what they consider capital versus repair. So sometimes the boards want to save money and not pay the sales tax, but then you're opening yourself up to exposure down the road. And signing a capital improvement certificate gets the vendor off the hook, but doesn't get the building, doesn't necessarily get the building off the hook. And like I said, in summary, though, with the budgets, it's a tough process, especially in hard times now with these buildings. A lot of people are out of work or getting pay cuts, and they don't want maintenance increases, but they do have a fiduciary responsibility to the building to do the right thing. And the banks are looking much more closely at things now. Purchasers of apartments are looking at the financials much closer. And when you have financials with deficits every year, it's going to be, it makes it a tough sell. And like I said, try to be realistic with the budgets. And now, who's next?
Thank you, Robert. Erwin Cohn is going to present next.
Thank you. Good morning, everyone. Good morning. Thank you, Margie, the Board of Directors, for allowing me to come up here and try to see if I could help you. A. Michael Tyler Realty, as you know, my name is Erwin Cohen, is managing agent, property managers for about 20 plus years. So I can't tell you how many budgets we've gone through over that period of time. Robert Messina has touched on a lot of subjects that are very important to the preparation and the formulation of a budget. The one thing, there's several things that I have to try to impart to you. First of all, I'd like to know who in our audience today are property managers, if you could raise your hand. Okay. And who are members of the board? Okay. And who are other? Let's see if you're paying attention. Okay. The most important thing that I could try to relate to you is the fact that in a managing agent function, you have to try to prepare a document called the budget that is saleable. It's got to be complete, it's got to be accurate, it's got to be substantive, and it has to have a logical and reasonable basis before you walk into or present a budget to the board of directors of a co-op or a condominium, or to a property manager, or to a property owner for that matter. What you need to do is prepare. And A conversation and a discussion on budget could take nearly a whole day of how to do it and how to sell it and how to prepare it. I handed out a few documents. I didn't bring enough copies for everyone, but if anyone is interested in getting a copy, just come up to me at the end of the meeting and I'll go through it. Now, the budget. History is a very important part of budget preparation because over the course of time, certain things are standard, repetitive, nearly non-changeable, or predictable. And that goes for both income and expense. When you're preparing a budget for income, and Robert Messina touched on several areas that were very important concerning how to raise additional money, what to do to restructure an organization, how to reformulate or reorganize what you're currently living with, such as a creation of an apartment or an additional income source. So I'm not going to address those things. I think Robert, in fact, I was taking very good notes of what Robert was saying. On the income side, I think it's very important to be very careful about how you account for potential income. And that is, make sure that the monies that you're presenting to the board have a very firm basis of where the co-op or the condominium or owner is going in terms of how money will be inputted into the organization. So careful accountability of your maintenance or common charges or rent. Factors that include other financial income have to be very carefully considered. Even with the fact that you don't want to include things like flip taxes or other interest income, those are areas that you could present in a budget but in a different area other than income, but at least provide for it. In the areas of expenses, I think it's very important to account, and I don't mean to make this thing vibrate the way it is, in order to account property is that you have to have a good handle on what areas of expenses you're going to identify. And for some of you, I prepared a little thing called a comparative analysis, which is nothing more than a presentation of, you can go back 3 years, 5 years, 8 years, 10 years, and see what the particular entity has been experiencing over that course of time. That will give you an indicator, a gauge, a measure of history in order to be able to predict the future on all these cost elements. Some of them are relatively fixed. Some are predictable in terms of percentages as it may relate to material cost, labor cost, insurance. You need to take each one of those elements and delve into them very carefully, dissect them, look at them, analyze them, and seek advice where you need to from experts in the area. You need, as a managing agent, you need to convince the board that the budget that you're preparing is not only accurate, but necessary for the proper operation of the property. Because there's nothing worse than running out of money 4 to 6 months, 8 months downstream and coming to the board and say, we need an increase. And then they're going to look back and say, what did we do to the budget? How did we come up to that number? That puts you in a position of trying to sell. You must sell what you have. And you must prove what you have to be accurate, all right? Certain of the major costs, when you get to things like mortgages, real estate taxes, water, sewer, and insurance, in most entities, I realize, add up to something like between 80 almost to 90% of your cost. Those are the areas that you have to look at very carefully. Real estate taxes, make sure that you're going to be using the services of some of the gentlemen that are going to be speaking today in terms of tax certiorari and petitions to challenge the real estate tax assessment. In the areas of insurance, discuss that with your broker. See if you can negotiate better arrangements on your real estate tax, on your insurance costs. See if there are ways within your own organization to compile, assemble, or negotiate a better arrangement through your agent based on leverage of whatever leverage is available to them in order to get the best rates for your individual co-op or condo. And we've been able to do that in many, many times. Questions after? Okay, yeah. Our water sewer rates, you know, are continuing to go up, and that, again, is something that is a fixed cost. There's very little that you could do except, and I'll deal with cost expense control and reduction in a minute or two. But those are costs that you could see experience with as you do with your real estate taxes. The mortgage, and that will be addressed shortly again by, I believe, Mr. Patrick Nyland. Look to see if there are ways to restructure your financial or your debt within the organization. And keep an open mind as to refinancing, whether or not you are facing potential penalty on prepayment of mortgage. Because in my few years in the business, that was when my hair was longer and darker, we were able to restructure the finances on buildings even with the payment of a penalty, and put the building in a very viable financial condition. So look at those costs. Perhaps lastly, the control of expense. There are ways that you could reduce your cost. There are ways to negotiate your contracts for materials and supplies. Look to your vendors to see if they can offer you ways to do that. Look to the control of energy cost. We're all discussing green. We're all looking at ways to control the energy consumption and the consumption of gas, oil for heating and hot water. Look to different ways to reduce water control, water consumption in the building. On each and every item, if you were to take a look at the typical budget, and by the way, the budget that I prepared here is based on a building which I've been pursuing for 25 years. We finally got the contract. It's called 123 Main Street, but I can't find it anywhere. They didn't tell me what state it's located in. But if you look at the numbers, most of the typical cost and income expenses and items are included in there. And what we have tried to do to help our boards understand and accept is to give the basis for all of the projections that are in there. In some cases, even down to the cost of a light bulb. So, again, like I said before, I'll take questions at the end. This is a topic that you could speak about for many, many, many hours. And in fact, it's probably the subject of a financial course in the Institute for Real Estate Management. All right, I thank you for taking the time, and hope that if there's anything or any advice or other ideas or suggestions that you have, I'm here. I'll be here until the end of the function today. Thank you.
We're actually going to segue into a very important part of the budget, which is the real estate tax process, actually the protest process. Bob Candell, followed by Paul Korngold, will try to remove some of the mystery that we all have in the certiorari process and the appeals process. So I know many of us find it a little bit difficult, and they'll try to put it in simple terms for us. Bob?
Good morning, and thank you for inviting me today. This is the first time I've been before your group, and I'm honored to have been asked. My name is Bob Candell. I'm an attorney with the law firm of K. Scholler. I have an interesting background in that when I was younger, I was Commissioner of Economic Development for New York City. And in that role, I was very much involved in discussing tax policy and how it impacts, at that particular time, was how it impacts business. But of course, it impacts residential life as well. And you don't have to be Karnak the magician to know that taxes are going to go up. The pressure that each of you feels at your buildings is the same pressure that the mayor feels. He's getting it from the unions, he's getting it from the cost of raw materials, he's getting it from the public who wants more services. It's the same dynamic that you deal with when you talk to your shareholders, you talk to your boards, you talk among yourselves. But the process is not without its own rhyme or reason. And the rhyme or reason can give you some tools that you can use and share with your colleagues, with your boards, with your shareholders to address real property tax issues. The fiscal year, you know, starts on July 1, it runs to June 30. The assessor works on a slightly different timetable. He starts his work for the next tax year about Labor Day. Labor Day is when the real property income and real property income and expense forms are filed with the City of New York. You may or may not be obligated to file them, but nonetheless, it's like the trigger for the assessor. They get divided up into districts, and they go out and they start to review their particular properties in September, because their target is to pretty much put the tax roll together before the holidays. They're like us. They'd like to take it easy during the holiday. The official publication date is January 15th. So somewhere between now and New Year's, they're putting the final touches, with the true final touches coming in those first 2 weeks in January. But what are we doing? And what can we do as building owners and operators and boards? Well, I think there's a lot that we can do. First of all, it's very important to know your own building, to know what's going on in the building, and to work with your certiorari council. You, as a building owner, as an operator, you are like the scouts. And it's in these early months of the fall, there's the opportunity for you to call up your certiorari council and say, let's review how we did last year. Were there open issues that we did not provide adequate information to the tax commission on? Were there questions raised that we could provide more information about that will help us make our case? What were the weaknesses of our case last year? That's one thing to be done. A second thing, look over your income, your miscellaneous income, your other income. More importantly, look over your expenses. Not only for the reasons that Erwin was talking about, but now you're looking to say, what among these expenses is anomalous? Is there something here which does not make sense to the ordinary reader, that is going to cause the tax commission to ignore the expense? But you have a good reason that a particular expense was high in that particular year. If you have the explanation, you want to bring it to the attention of your council so it can become part of the mix, part of what gets considered by the assessor as he's evaluating your property. It's very important, or I think that you all have the opportunity to be the advocate for your building. I know you appreciate that tax council have many, many properties, but you have the one that you're working on. And by putting together and pulling together your information about your own property, you can bring it to the attention of your tax council and ask in a very early, timely way, what can we do with this information? What can you do to develop a strategy? Do we have information that we should be bringing to the assessor's attention now before he puts his pen down and gives us our tentative assessment? Or is it something that's going to have to wait until we go before the tax commission? But by advocating for your own building, you will put pressure on us to think about your building. And if we're thinking about your building, you're likely to get the best of our thinking, the best of our strategy, the best results that you can hope for. I think that then you're in a position, as it comes time to work with council for the filing of the actual protest petition, to achieve the results of the work that you do during the fall. I'll be happy to answer questions during the question and answer period, and thank you.
We'll now hear from Paul Korngold on a related topic.
Thank you, Bob. Now I don't know what to say. Glad to see everybody here this morning. I've been reading the paper that this place is in bankruptcy and foreclosure, and a motion was made in, I think, the bankruptcy court the other day by the present operator to keep it open through Christmas because that's where they're making money. I guess the motion was granted because we're here and no one barred me from coming in today. Bob talked a little bit about the process, and it's confusing. You know, Churchill once talked about the Soviet Union and said it's a riddle wrapped in an enigma, and I think that was easier to understand than real estate tax practices. I'm getting questions from a number of people here today, and I get the phone calls, what's going to happen next year as far as taxes? And Bob and I, when we hear about next year, we think about the next tax year usually, which starts July 1, but I know managing agents need to know the next year, which starts in about 3 weeks. Well, the first bit of bad news I have to tell you is that the city increased the tax rate. I don't know if you know that, the tax rate went up. So even if they were in the middle of the tax year, you're going to get an increase on your bill, and you better be prepared for it. I think most of you are residential realty managers, New York Association of Realty Managers, residential, right? That tax rate just went up. It went up from 13.053, which was billed on July 1, to 13.241. But it really is higher than that. And the reason I say that is what happens is the city sets a tax rate every year. And a number of years ago, what was happening, the city council couldn't decide what they were going to do, and they'd be delayed in sending the tax bills out. And when you were supposed to pay by July 1st, and the bill didn't show up till June 28th, by law, they had to give you an extension. So what the Department of Finance started doing is billing everybody on last year's rate. And that's what happened on July 1. You were billed on last year's rate, which was 13.053. So what happens on, don't worry about the numbers, that's for the accountants. But what happens essentially is on January 1st, not only do you have to pay the increase, but guess what? They underbilled you on July 1. So now you got to pick up what you should have paid on July 1 if the city council was doing what they were supposed to do and set the budget on time. So you're going to pay a higher tax on January 1. So if you have a mortgage with an escrow company, they're going to be asking you for more money. If you're paying the bill, if you didn't get the new bill from the city yet, it's going to be like Santa Claus. It's coming. And whether you've been naughty or nice, you're going to get that bill. Next thing, what's happening on the next tax year? Are my taxes going to go up because everybody knows that values have gone down? Well, guess what? I don't know. Bob doesn't know. But I could tell you that even if values go down, you're probably going to have to pay more taxes. And why is that? There's something called the transition assessment system. And I don't want to go into real details on that because we'll be here till beyond the bankruptcy. But essentially what happens is when your tax assessment goes up, and over the past few years, values, we have to agree, have gone up until recently, the city phases that increase in over a number of years. So basically what happened is, let's say you were assessed at $1 million, and then the city raised you up to $2 million. That would be phased in the first year you'd only pay $1.2 million, then $1.4 million, then $1.6 million for the 5 years. Well, we all know that your assessment never stays constant, so after it goes to $1 million to $2 million, they raise you to $2.5 million, so they pick up that increase. So now you may have a situation where these transitions are running up, and you were assessed at $2.5 million, and now the city assessor comes around and says, oh, this building isn't worth as much. We're going to take 10% off. I'm going to drop the value to $2,250,000, okay? But because this transition track is coming, because you haven't paid on that increase in past years, you're going to pay more than you did last year, and your transition assessment may go up to like $1.9 million. And your certiorari attorney is going to say your actual assessment went down. You are going to look, your actual assessment went down, but your transition's going up. So I'm telling you, the odds are, even if either you get a certiorari reduction or the assessor voluntarily decreases your assessed value next year, the odds are pretty good that your taxes are going up. Sorry, I'm just the man that's delivering the bad news. Next, your market value. How many of you are managers for co-ops and condos? And how many of you just doing straight rental buildings? Okay, so on the rental buildings, and Bob talked about these RPIE statements, you would have had to fill out an income and expense statement, and the city assessor looks at how much money you're making, how much money you're spending expenses, uses a capitalization rate, and comes up with what your assessed value should be, theoretically, if he didn't take off early, as Bob said he liked to do for the holidays. On a co-op or a condo, it's based upon comparables. You're not filing an RPIE. So the assessor's going to take a look at what he thinks your rent should be in your building and thinks what your expenses should be and apply what he thinks the capitalization rate would be. For those of you that don't know, on co-ops and condos, the fact that the market price on the units are going down, it's irrelevant. The building was never assessed based upon the value of the co-ops and condos under their sales. It's always based upon what the economic return, the law says, as if it was a rental building, okay? So that's to put them on the same basis. We'll let Greg decide if that's good or bad, but that's another story. We know his opinion, but I'm not going to give his opinion away. We talked about transition, we talked about co-op condos. I think I just want to spend just 2 minutes about various abatements. I think we all know that that co-ops and condos, thanks to my friend Mr. Carlson and others, get a co-op condo abatement. And most buildings, it's 17.5% a year. So if your taxes would normally be $100,000 a year, the city gives you back a rebate of $17,500. And thanks to the work of all the accountants, they've told all the co-op boards to immediately pass a special assessment, which miraculously is equal to 17.5%. So by law, it's supposed to go to the shareholder, but it's really nothing more than a budget trick to get money into the co-op budget. If you have a J51 tax exemption, you can't get the co-op abatement. However, most co-ops don't have J51 exemptions, they have J51 abatements. There's a difference between the two. So don't hesitate to apply for a J51 abatement if you put a boiler in or something, or new windows, and think that perhaps you won't be able to get your co-op abatement. No, you can get that. You probably won't get a J51 exemption. Is usually for like gut renovations, converting warehouses into apartment buildings. So that's still preserved. Stuyvesant Town, I'll talk about that for 1 minute because that does relate to J51. For those of you who don't know, there's this project down in around 23rd Street called Stuyvesant Town. It was recently the subject of a lawsuit. The case was based upon the fact that Stuyvesant Town had gotten a J51 for windows and electric, and for years the State Division of Housing had been telling everyone, including the owners of Stuyvesant Town, which was then Metropolitan Life, that even if you got a J51 for individual items like this, it didn't prevent you from going through vacancy deregulation if the rents were over $2,000. Well, the Court of Appeals overturned that and said, no, that's not what the law, even though that's what the law says, that's not what the law meant. So that's what it is. So that's where we are. The court says that's what it is, that's what it is. However, for those of you who have co-ops, number one, I wouldn't worry too much about this decision because there's a special exemption in the law that co-ops and condos do not have to be rent regulated. They should not be affected by this law. I think the only ones in co-ops and condos that should be concerned if you have a significant sponsor presence, there may be an impact on you if the sponsor thought that they were getting rid of somebody and somebody comes back and files a complaint on the basis that at the time that they were told they had to leave under vacancy deregulation, the building had a J51 and someone may start something on that. Now I'm done. Thank you.
Thank you, Paul. We're going to switch gears a little bit back to the management field. David Lipson is going to speak a little bit more about budgets.
Thank you very much, Michael, and it's an honor to be part of this panel, and appreciate everybody being out today. Greg, what happened to the teleprompter? It's not working today? No. Sorry, that was just trying to lighten the room. A bad joke.
I can't read anyway.
I'll speak a little closer. Okay. Budgeting is a very important part of running a building and making certain that you have enough expenses to cover your operating, enough income covering your operating expenses. But an area that I want to touch upon, which Robert, our CPA, included in his remarks, and to me is the most critical part of running a building, is looking long-term, multi-year perspective. Having an eye on your capital needs and making sure you have the proper funding in place to cover those projects as they come your way. And doing it over a 5-year plan, even as far out as 10 years, because many of the mortgages have a 10-year term, and you want to make sure that the life of your capital, the life of your building systems are planned out in a way that you have the funds in place. And one way of funding these projects is through mortgages. Today's rates are extremely reasonable, but there's other avenues as well to fund the projects, whether it's lines of credit, second mortgages, and the dreaded assessment, which I know many of the buildings don't like to have to deal with, but they're faced with having to do that because they don't do the careful planning. A keen eye on the analysis of the cost of maintaining, repairing, and replacing the existing components is an important aspect of the blueprint of this planning, so that the board's not operating in a vacuum, that they have a really good view of the entire property. Now, I'll switch gears to talk about some other little items which I think are important for a building to enhance the value of the property. And you can look at income-producing projects. I think that was also touched upon by Robert. He certainly hit some good points, but these are my notes, and I want to work from what I know best. And we've done many projects in buildings that are exciting and add value and can pay for themselves in a relatively short time, and then you can earn fees back from them. One is a gym, which is an excellent way to take an empty room and turn that into an enhancement and also an income-producing project. Storage rooms is another area you could take use of that, and a lot of co-ops have been looking at the antennas and adding income that way. Bike racks and all these other little projects that are out there that are projects that will enhance the property, and at the same time you'll get some income on it. Looking at increasing the operational efficiency of the building systems and doing preventative maintenance is also a critical piece of managing a property, and it also dovetails into budgeting. Preparing your staff to be sure that they are equipped to run your property properly and get them educated in courses with NYARM and the 32 BJ. These are areas that one should focus on. And also, formulating expenditure policies, the areas that you can control. This is 80 to 85% of the budget is non-controllable, except when we have wonderful certiorari attorneys doing things that can help you out in that area. Other than that, I just want to end. I think the board should not have their hand forced by political pressures, and they should look at the budget in a way that it's a business, and they have to be certain that they are covering their expenses. And again, it's the big picture you have to look at in the long term of the property. I'll leave it to, we have many more panelists to speak, so I'll pass the baton.
Thank you, David. We're going to have Pat Nyland now discuss the mortgage refinancing process, mortgages, how they affect your budget.
Thank you, Michael. I'm president of First Funding, which is a commercial mortgage brokerage firm that is specialized in financing for multifamily properties, co-ops, and condominiums since 1987. And over that time, I've been through several cycles, both ups and downs like we're currently experiencing. And I think I'd like to underscore the importance of preparing a budget, a comprehensive, realistic, balanced budget, as everyone else here has already mentioned. Because without that, you can't properly manage the property. A budget is nothing more than a management tool. So your ability to deliver good management is going to depend in large measure on the quality of that budget. And not just the budget for this coming year. But as David just mentioned, you have to look at the period beyond this coming year for those things that will impact the budget and perhaps should be included or represented in some way in this year's budget. And the second issue is, when should that budget be prepared? Anybody have an idea? When is it due? When should we have it done? Or when should the board have it done? Now, before the start of the next year or fiscal year. And I can't tell you the number of buildings that I work with in April that still don't have their budget for the current year. And they say, well, it's just like last year. And all of you in this room, I'm sure, know that the budget for this year is not going to be like the budget for last year. And so you really have to encourage the boards to work hard before the end of their current year to have their budget prepared for the following year so they can actually use that management tool and deliver for the ownership. Now, lots of things can affect the budget. We've already heard about real estate taxes. There are going to be increases in labor rates, fuel costs, and all of the other operating costs of a building. So the building and you together have to work to assess what those increases will be. Now, we're in a rather lackluster economy right now. And so a lot of those costs aren't going to go up as much as they otherwise would. But 12 to 18 months out, we may be looking at an entirely different marketplace. And I think that's something that has to be factored into the preparation of every budget. Now, there's a component of the budget that represents a large section of the budget that is often overlooked in this analysis, and that's debt service. And it can take various forms. Many cooperatives, for instance, have a credit line. That's variable rate debt. So now when interest rates are low, prime rate's 3.25%, 30-day LIBOR is 0.24%, essentially zero. That's not such a big issue. 12 months, 18 months, maybe even 6 months, depending on how the world reacts to things that are going on now and decisions that the current administration will make. We could be seeing a dramatic increase in interest rates, and suddenly whatever percentage of the budget that is represented by that credit line debt is going to be going up and up and up. Now, that's going to play havoc with your planning. If a building has the old-fashioned 5-year loan or 7-year loan with a 5-year renewal option, that could be coming up too. And so depending on when that happens, you could be having a significant impact in your budget. Or if they have the more traditional 10-year loan that's near its end, you also could be confronting a refinancing. And even if it's not going to happen next year, you should be thinking about when does it happen and what are the things that we should be setting aside now in this budget so we're in a good position to take advantage of whatever the market is at that time. And finally, I would say that every building, given the current interest rate environment, should at least be doing an analysis of their existing debt. Now, I'm not saying that you're going to rush out in the market and refinance, because that may not be a good idea. But every year, as part of the budget process, you should have your accountant help you prepare an analysis of whether or not it makes sense to refinance the underlying debt. Lots of mortgages, virtually all mortgages, have a prepayment penalty. But depending on the disparity between the note rate and the current market rate, you might find that it makes sense to pay that penalty and lock in today's rates for a much longer period of time. Because the one thing I absolutely am sure of, I don't know when it's going to start, but I'm absolutely positive that we're going to see much higher interest rates in the relatively near future. Now, if I could tell you when and how high, I wouldn't be here because I'd be sitting on a beach someplace. But that's something that you have to consider in your planning, is that in the future, relatively near term, you're going to be looking at significantly higher costs of raising money for your buildings, be it a rental building, a co-op, or even a condominium that needs rehab financing. And so that's something that I think that definitely should be part of the discussion. Thank you.
Thanks, Pat. Another major component of our budgets is energy, and Stuart Warshaw from Raw Energy is going to touch on that a little bit for us.
First, thanks for allowing me to come here. I met Margie, I guess about 2 or 3 weeks ago, and I told her what this thing does, and she looked at me and she said, "Why doesn't everybody have this?" And I looked at her and asked her, "Well, you tell me. You seem to represent a lot of different people." So she said, well, she invited me. She said, "We're having a budget process, a budget seminar." So I'm going to give you a quick overview, and it's not going to take a long time. This is a very technical product. It sits on top of a boiler, and it's guaranteed to save 10% of fuel consumption. It saves generally 15 to 20%. We've heard now more than once about energy being a huge component of the budget. We all know about it. It's also terribly unpredictable. You're going to, this year, try to figure out what you're going to be paying next year for energy. Nobody knows. The way this thing works is, or what it is a device that goes on a boiler. It is It's been around for about 10 years. It's called the Fuel Economizer. It is a patented product. It is a product that was tested by Brookhaven Labs and funded by NYSERDA for that test. Everything was validated. This thing saves well over 10%, generally 15 to 20. The New York City school systems are installing these in 1,200 buildings. Many school systems in Long Island, this is actually a local company, Teledyne. Many systems in Long Island have it. It works. It is really quite impressive. And I think about the budget process that you're all talking about, and it is something that can fit in a capital budget. It is about $7,000, depending on the conditions of the boiler, installed. If you think about the numbers, if you guys are burning $50,000 or let's say $70,000 a year in fuel consumption, not an unusual number. In fact, many buildings are in the 100,000, 200,000, and 300,000. For $7,000, you can save $7,000, $10,000, $15,000 a year. Pays for itself generally in 1 year. I think that the question I would like to almost ask, and maybe afterwards with the Q&A session, is why doesn't every building have this? I don't know if people have heard about it. It's been, sorry? This is called a fuel economizer. It is made by a company called Teledyne. Our company is Raw Energy. We install it, we sell it and install it. I've known this company for quite some time. I have a question.
I think everyone's got the same question. How does it work? Exactly. How do you hook it up to the boiler?
Okay, do you want me to do that now? That is, and this is very difficult. I'm happy to do that, to explain it right now. I want to wait for the Q&A. Margie said, please keep it under 5 minutes. I'll give it to you very quickly.
You have my blessing.
I do? You have it?
You could have an extra 5 minutes.
Okay. First of all, it does work with Heat Manager, since most of you probably have that on your system. What it does is it changes the firing pattern of a boiler. It connects to the burner. It is what sends the signal to the burner when it can fire, whether it works with steam and it works with hot water systems. Many times, I guess essentially it's built on the concept that your boiler is sized to heat your building on the coldest day of the year. Every other day, it's oversized. So when it needs to fire up, either to create hot water or steam, you're firing up this very large, oversized vessel to do just that. And it may be just to provide a small amount of heat that's required. It has a couple of sensors. This is one for a steam unit. There's a steam sensor here. There's also, if you do domestic hot water, there's a domestic hot water sensor. If your boiler provides a domestic hot water, there's a domestic hot water sensor. It understands what your building's needs are in terms of BTUs because it knows how much your existing aquastat or heat manager is calling for heat and how much pressure or hot water is coming through the system. So in real time, dynamically, it knows right now there is either a large demand on the heating system, which would be on a very cold day, or a very modest demand on the system. If it's a modest demand, it will hold off the firing of the burner, and it's a microprocessor, it's a computer algorithm. It will hold off the firing of the burner until it sees fit that it can allow it to burn. So the amount of time that it holds off the firing is greater than the amount of time to get the burner back up to where it would have been if this doesn't exist. It's like hidden yardage in football, and it adds up to essentially about 15% savings. It doesn't sound like a lot until you put the dollars down. At $100,000 a year in fuel, $15,000 a year of savings is pretty impressive if this thing only costs $7,000 installed. The people, there's a residential business that we have, and quite honestly, the people who immediately take to it in less than a minute are the financial people. I have a good friend. He's got a place, I'll speed it up. He's got a place up in Bedford. He's got 5 structures on it. We spoke about it. He said, immediately, I want one in each of my houses because it is a financially driven product. The other thing I don't want to miss out on, it fits a green agenda. By virtue of fuel savings, plain and simple, if for every 10,000 gallons of fuel burned, that's, if you save 1,000 gallons, you're talking about 30,000 pounds of CO2. 15 tons. If you're doing a 40,000-gallon building, that's 60 tons a year. I don't know, I mean, we're all talking about green and clean. This does it for oil. The nasty pollutants, fine particulates, carbon monoxide, and hydrocarbons are reduced by about 50%. This is all the product of the NYSERDA Brookhaven study. So I'm getting the cue to get off here. We'll have some cards and information, but that is what this is. Would love to see it.
We'll do the questions
You-
later. Yeah, hold on. Yeah, write it down.
Okay. Thank you very much. Margie, thank you.
Thank you. I'm going to introduce Dan Wallman, who's going to handle our question and answer period. Just a couple of points. I've been listening to all the presenters, and certainly this is a powerhouse panel you put together, Margie, so thank you, and thanks to NYARM, and thanks for all of you coming. A couple of things that we didn't touch on, is float. How much money do you need in your operating accounts to pay your bills monthly? So if you did your forecast for the current year and you're preparing your budget for the next year, did you take money out of your reserve fund? How did you provide for any shortfall maybe you didn't anticipate? So that's important as well. And how are you going to finance that or make that up, in 2010? The other thing is when you present your budget, how do you present it? You just email it to the board and say, here, good luck, I'll see you next time? No, I would hope that you review the years prior, and any large variance, anticipate the board's questions or your client's questions. Look through your budget, go through the line items, and it shouldn't take you very long, and really figure out what could they possibly ask me in a meeting that maybe I'm not prepared for, but I can prepare for, and appear and be that much more intelligent about it. But as we all said, these budgets should be getting out now. Pat mentioned some buildings where clients don't have calendar year budgets until April, which is really something that you're going to get a lot of heat for, no pun intended. So with that, I introduce Dan Wallman, who's going to run our Q&A session. Thank you. And anticipate.